All right, all right. Good morning, everybody. Give me just one second. As always, just got to pop onto my goodies over here. Make sure my screen share is working. So let's get that up and running real quick. Let's see. Yeah, window, calendar, share. There we go. Happy Tuesday, everybody. It is Tuesday, right? Yeah. Tuesday, February the 3rd, 6:30 a.m. Central Standard Time here in the Kansas City area. As always, and we are going to take a look at some charts today, some top setups, some economic calendar events that can potentially affect the charts today. Okay, the assets that we like to trade. So let's get this show on the road. Guys, as a recap of last night, as I continue to pound down my caffeine, get up and running this morning so I can start turning some cartwheels. Last night, we did have Australia's cash rate statement come out where they did increase their rates by 25 basis points. Now, this is the first time for Australia that they've touched their rates here in a couple years. Okay, so it's been a while, but they have finally started to acknowledge some changes. And I went through the liberty of digging into the Reserve Bank of Australia's rate statement for you a little bit, just to get some key elements from that. And here we go. Thanks to Grok helping me parse and sift and sort for us. So, just like it says there, board delivered a 25 basis point cut. The cash rate is now 3.85%. Instead of the 3.6% they were hanging on to for dear life. This is, again, the first hike in over 2 years and a reversal from the prior easing cycle. So this is inherently, of course, a hawkish action. Okay, we always want to know, is a statement, is it hawkish or is it dovish? So just the change in itself, okay, is inherently hawkish. So good for the currency. Tightening of monetary policy. And they've thrown the big bag. I cannot talk this morning. The big, bad, ugly word inflation in there. Okay, resurgent inflationary pressures. So here's a couple of the key elements. So they have acknowledged that, of course, inflation picked up materially in the second half of 2025 and is likely to remain above the target for some time. Okay, so that's part of raising the rates, is to fight the inflation. Let's see, what else did I see on here earlier? Greater momentum in demand, stronger than expected private demand. This is, of course, household spending, investment, all that kind of stuff, house market activity. Okay, trying to fight those inflationary pressures. Unemployment was lower than expected. And then skipping down here, what did we see here? Yeah, so obviously they're talking about demand. And I'm reading through this real time just with you. So, of course, there are risks if the demand grows stronger or supply capacity remains limited, which could add pressures. Upside surprises in global growth and trade with major partners have little depressing effect on Australia. Now, the board, and this is the same thing you see in every speech, okay, regardless of what country you're looking at, but they emphasize the board will do whatever it deems necessary to achieve price stability, full employment, with close attention to the data and the risks. Okay, that's the same lingo that we get in every single speech, it seems like. They need to come up with some new words, keep us on our toes, right? But if there's one thing markets like, it is stability, and there is stability in getting the same speech every time. We obviously want to look at data and look at risks in order to pay attention to it to see if they need to change things in the future. So the good thing about this decision, and partly why it was so hawkish, along with all these things, is the fact that it was a unanimous decision. So you did not have any dissenters saying, nah, we need to keep it the same. We need to keep it at 3.6%. Okay, it's always good when you get that, because that kind of gives the currency, I think, a little bit more of a, for sure movement. I don't want to say for sure movement, but consistent movement. Okay. It's not like you had a 5-4 decision where half of them wanted to, remain the same at 3-6. So all of their board members did decide to go ahead and jack it up to 25 points. So, as a result, guys, we should start to see some Australia strength, which I'm excited about because I'm actually still in my Aussie dollar, US dollar long position. So we'll get to that in a minute. But let's just go take a quick look at the indexes. Indices. Oh, hold on, guys. Got to turn my goodies on. My screen vanished, so give me 1 second to get it turned back up. There we go. I got my space heater under my desk, and so every now and then it'll trip the surge protector on it. And my monitor, not my laptop, but my other monitor, my second monitor, is attached to it, so it'll shut off from time to time. But anyway, take a look at Australia's goodies over here. Okay, so this was 9:30 my time last night, so that would be, well, I guess as far as the index, it's not even up and running yet. Monday, yeah. So this closed it, so it's not even up and running yet, so we can't even look at that. I did want to take a look at a couple of these indices here. There's your VIX. Okay, we had another spike up, but another bounce back to the norm. So volatility looking in line. But going back to the Australia index real quick. So, I got into this trade yesterday, the Aussie dollar, US dollar long position. And part of the reason is because we bounced. Okay. I like to look for confluences with the index of the two currencies I'm trading. So in this case, the Aussie, or the AXI, which is the Aussie index, and then the Dixie, of course, which is the dollar index. So one thing I did observe, we did drop into a daily demand for the Australia index, which is good. I like to see that if I'm trying to buy the actual Aussie dollar pair, or really any Aussie-based pair for that matter. Okay, it's good to see that in confluence, we dropped into the daily demand. It's a daily demand, and I know this because we had a gap. So there's going to be our gap right there on the Aussie index from this candle to the bottom of this candle, showing that demand greatly exceeded supply. So if demand greatly exceeds supply on the AXI, the Australian dollar index, then there's a pretty good chance that could translate into the actual currency pair. So that's your AXI. And not to mention, guys, you look at this, and this is a daily chart, and you can clearly see this thing's just going straight up. So anytime I get into a long position on something, I need a pullback. I need a very short-term downtrend like we got the last couple days. Okay, last couple days of trading on the Australia currency. Okay, so short-term, and it's, it looks more prevalent, obviously, when you drop it down a time frame or two. So just getting rid of my moving averages for a second. Okay. This right here, just my downtrend from this point to here is down. It's down, is it not? It's even more prevalent when you scale out even higher. Okay, there's your 5-minute time frame. Is that not a downtrend? Okay. I mean, you had a big spike down, big retracement, and then kind of a slower grind down. But that's what I want to see. I have to see a short-term counter trend. Okay, counter trend. But in the grand scheme of the overall higher time frames, it's clearly an uptrend. So you got to get that. I got to get that whenever it comes to buying in demand zones. And the same is true in reverse if I'm trying to short sell in a supply zone, right? So there's your AXI, and here's your Dixie here. Now, there are some potential headwinds with this Aussie dollar trade I am in. I mean, it's, I'm in the money at the moment, $887 unrealized, okay, on one account. The other account, I've got 3 accounts now, by the way. I'm about to start trading on my third account, probably today, actually. But my second account is profit. It's 450. Okay. But again, this is unrealized. Now, I've moved my stop losses to break even. So no matter what on these trades, I can't lose any money. Okay. I'm going to focus today on kind of trail stopping on the Aussie dollar on both of these charts I'm in. And at least lock in a few bucks, cover the swaps, cover the commissions, things of that nature. But looking at the Dixie itself, okay, here's our most recent swing high, our most recent swing low. And you guys see this big, ugly rectangle to the left. That is a much higher time frame demand zone. That is my monthly. Okay, if I scroll all the way out, monthly chart, okay, there's my monthly demand right here. So that's where we've been in since June, okay, June of last year, so mid-year last year. It's just been, we had that big sharp drop from the start of Trump's presidency, which is typical of Republican presidencies, okay? It's just a typical thing to see the dollar drop, the stock markets go up. So anyway, we had that big sharp decline the early part of the presidency, and now we've hit it, bounced into this monthly demand zone. So we're looking right here at this candle here. Okay. And it's got a gap under it. It's not the biggest gap, but it is a gap nevertheless. So that's where we kind of got stopped in our tracks on a monthly time frame, on a higher time frame. And then, of course, there's another demand zone below. There's even another demand zone at the origin of this overall strong move up that started in April of 2021. But only thing I am worried about, not worried, but am concerned about right now is this current monthly demand zone. So that is a potential headwind. But am I really worried about it if it hasn't went screaming up, since it dropped in June? Not really. If this monthly demand zone was as strong as it was, okay, it would have pushed price up, a lot better, a lot quicker, a lot sooner. But it's just kind of dilly-dallying around. I very easily could see this thing chewing through and just running on to the next demand zone. Or obviously, if we get some big changes fundamentally, then I could see it traveling up to this top monthly supply zone, clear up here. Okay. There's our monthly supply zone. I just haven't drawn it on yet. Do I have a gap above that? Let me look. No. See, I don't want to use that candle right there, because that candle, if you skip the next candle, it overlaps the second candle right here. So that is an efficient market structure. Okay. So I can't utilize that candle, that indecision candle, as my monthly supply zone. This one, however, I can, because there's a gap under it. Okay, remember, those gaps are important. They're very important when identifying supply and demand zones to make buying and selling decisions off of. Okay, there's our gap right here, monthly gap. So skip the leg out candle, wrap a rectangle around the indecision candle right before it. Now, obviously, guys, you see that this swing high does go up a little higher. So when it comes to, if I were making a buy, if I were trying to short sell in this monthly supply zone, then I would obviously put a stop loss above it. Okay, because it's not that much extra. So it's not like it's going to take, a ton more of a reward to risk out of the equation. But you guys know the prices quite often can visit the extremes, the extreme swing low, the extreme swing high, even on a monthly, monthly, weekly charts, a higher time frame. So anyway, that's, oh, and by the way, I need to color that orange because I make my weekly and monthly supply and demand zones. I always wrap them in an orange rectangle. So anyway, Dixie, that's higher time frames. Let's get back down into this area. Okay, with this Aussie dollar long trade, I would absolutely love to see the dollar weakness, the Aussie strength, obviously. So do I have any real, do I have any supply zones kind of pushing the Dixie down? Well, I have one clear here at the top on this daily. We're back to the daily time frame now. Okay, a daily supply zone at the very top. Potentially, we could get some resistance in this area here. That's a little bit too big of a candle to draw up. I cannot utilize the green candle for my daily supply zone because the bottom of it overlaps the second candle over. That's an efficient market structure. Okay? The inefficiency in this swing low, swing high sequence is here. So it's a little higher up. So this isn't necessarily giving my Aussie dollar long trade great vibes, because I would prefer that we had a supply zone, where price is now. We don't have it. We don't have it on a daily. Okay. So let's go look at some smaller time frames. Okay. We got another resistance point up in here. So obviously that could be a potential spot to, if price goes against me, if it goes against my trade, then obviously there could be some resistance in here to, kind of push the Dixie overall down, okay, back down. So that is a potential there. But let's just go ahead and skip on over to the trade itself. The Aussie dollar long trade. Now, just keep in mind, Aussie dollar is still giving me a bullish signal of a 5, a bullish plus 5. Now, when I got into this trade, just like I showed on my shorts video yesterday, when I got into this trade, it was a plus 7. Okay, it was up in the middle of this section here. So it's clearly gone down in strength a little bit. Now, this is something that isn't going to force me to close my trade. Okay, price is coming back down. I mean, it's at the end of the day, it's still bullish. It's just not as bullish as it was, right? Something I like to do is go take a look at trade history on the asset that I'm looking at just to see what the previous scores were, the last day or two or three or whatever the case is. So if I go over here to my top setup score history, this is going to show me the last, whatever period I want to put in. The scores, the daily scores for the underlying asset, in this case, Aussie dollar, US dollar. So we go all the way back to the 29th of January. This thing was a plus 10, which is very bullish. Okay. The next day, it dropped to plus 9, and it stayed there for a couple of days, plus 9, plus 9. Then it dropped to a plus 7. This is when I got in the trade. This was, for me, the Sunday evening open, because the market's open here in the States. Where I'm at in Kansas City area, it opens at 4 p.m. Central Standard Time, right? So Sunday evening is when I got in this trade, and I got into it because it was a plus 7. But now we're down to a plus 5. As of yesterday, Monday, it went down to a 5. So you guys can see we've kind of got a little bit of a miniature trend going, do we not? So we had a miniature trend, upward trend, and now we've kind of flipped the script a little bit and kind of started a little bit of a downwards trend on the scoring. Okay. So this is just something that I would want to be aware of. If I were getting into this trade today, then I would probably avoid it. But because I'm already in the trade, I'm going to manage it. I'm not going to close it just because the scoring is starting to go down. Okay. So, but again, this is just nothing more than a little bit of an extra odds enhancer. When I got in this trade, I liked the spot it got into. It dropped into a 4-hour, 1-hour demand zone confluence. I hopped in it. But anyway, it's just something to be aware of. And then, yeah, like I said, flipping on over to the trade, guys. Here's our Aussie dollar position here. Get rid of that. So this is the trade I got in Sunday evening. So again, I was looking at this 1-hour demand zone down here, and you guys see it just bounced in beautifully. It just bounced in perfect. We hit the zone. Bounced up. We kind of formed this double top action right here. Okay, this little cluster of wicks, We got a rejection. And all I needed to see to feel really good about this trade was a break and a close above this little double top. And we got that. Okay, we got that, yesterday evening. Yesterday evening. Would have been 7 p.m. my time. So 7 p.m. my time, that's when we got this close. And at this point, I felt pretty good about things. Now, I had to keep in mind, though, that Australia's rate statement was to be had at 9:30 p.m. my time. Okay. But I felt pretty good about staying in this trade because, again, previous number, it was at a 3.6%. It was projected to go up 25 basis points. And by all accounts, it looked like that was the trajectory that it was going. Okay. In other words, not necessarily going to be missing expectations and remaining the same at 3.6. So I went ahead and stayed in the trade. Now, if that would have been the opposite, if this would have been projected to obviously decrease rates, then I'd have been out of this trade. I wouldn't have even given it the time of day. But even so, even though I felt pretty good about that, guys, I still went ahead and trailed my stop loss up here to above break even. So obviously my stop loss started out down here where you see my scroll, my zoomy. Okay, it started off down there. But then when we broke this structure and closed right here, well, that's when I moved my stop loss from here to break even. I've moved it up a little higher because I ended up going under this swing low here, to cover my swap fees, potential swap fees, and obviously commissions. The unhidden tax of trading. Okay, the stuff that they don't really talk about, but they end up charging you anyway. And as far as the carry trade scanner, it's pretty much the same now almost. Remember, the U.S. is at 3.75%. And now we got the Aussie dollar at 3.85. So actually, you're getting paid 0.10%, or I should say 0.10% more now to hold the Aussie dollar. So this all of a sudden, ladies and gents, this trade all of a sudden went from me owing swaps to now they're paying me swaps. because of the change in the Aussie dollar's rate statement. Okay, let's go look at our carry trade scanner. We got to go find that. Let's see here. Carry trade. There it is. Carry trade scanner. Okay, remember, this isn't something that, if you're a day trader, if you're just trading like scalp type trades or small time frames, this really isn't that big a deal. It's when you start doing longer term swing trading, multi-day swing trading or position trading. Those are the people that know the ins and the outs of this. So let's go find Aussie dollar on this list. Okay, there it is right there. Okay, so the other day when I got in this trade, this was actually painting a red color. Now it's painting a blue color. It was a red color because the Aussie dollar was a 3.6%. And that means by buying this currency pair, I would be paying a swap because it's less than the US's 3.75%. Okay. Fast forward to last night, they jacked their rates up 25 basis points, and now they take over the US dollar, and actually now I'm getting paid. So it's kind of funny and ironic to open up a trade to where I'm paying swap fees, and before I close it, they're going to be paying me swap fees. Okay. So thank you. I appreciate that, Australia. Okay, you're gonna refund me back the swaps I paid from Sunday night, Monday night, and I'm sure that I guess they'll take effect today. So, assuming I hold this trade open until tomorrow at least, then that's where I'll start getting the payback. So, anyway, just thought that was kind of funny to point out. But yeah, there's nothing for me to do right now. Okay. I'm in the trade, just going to let it do its thing. You guys see I did paint a supply zone box up here because I do have that 1 hour supply zone up here that I have to be aware of because my profit target is at the origin of this overall strong move down. It's up here. So by the time we come up a little bit more, we start entering into this hourly supply zone. Well, then I'm probably going to go ahead and move my stop loss, my trailing stop, from where it's at now. I'll probably go ahead and move it up for sure I'll move it under this spot here because I do have a demand zone that's painted up. See that newly created demand zone? Okay. That's actually a nice little scalpy area that I might look at on one of my new account as far as getting into a position, because I've actually kind of played around with some moving averages, some overbought and oversold indicators. To where I'll probably on my brand new account. I've got a third account now. It's a 100K account. It's an instant funding account, so I don't have to go through the challenge account or the challenge phase. I just go straight into the funded phase. So I'm keeping it separate though. I've got just kind of going back over here. This might be something I get into talking about more as I go along, but basically, in a nutshell, this backbone strategy. Let's just go ahead and open this anyway. Okay, in a nutshell, whatever asset I'm looking at, I want to have a daily chart on the left. I want to have an hourly chart on the right. On the daily chart, I want to look at my 8 period and my 21 period EMA as far as the moving averages. And whenever I get them both pointed up at the same time, just kind of verifying the trend. Okay, the 8, this will be the 8, this red one over here. And then the 21, which will be this light red. As long as the red is obviously above the lighter red, then that's just kind of when it comes to the theory of this strategy I'm testing out and playing around with, that just simply means uptrend. Okay. If and only if I get that, then I pop over here to my hourly chart, which is the action chart. And now I've got a 50 and a 20 period moving average. Okay, the 20 I've made dark blue, just meaning slow. That just tells me in my head, okay, that's the biggest moving average because it's slow. This one's the faster one. It's a little lighter blue. So as long as these are pointing up, then all I need is a retracement back down to the moving averages, okay, to where I could perform a trade, but only if my RSI 6 has pointed below the 20 line, okay, showing a major overbought signal, oversold signal. I'm sorry, guys, oversold. If and only if all that occurs, then I get into the trade. But of course, I have to add my own little spin onto it. And my spin says, okay, if I see all that, I get my volume spike. Okay, this is where I'm pulling my flavor into it. Then all I need is to make sure that now when we drop, we obviously drop into a demand zone. Okay. Same is true in reverse as a short selling. So this is a cool little strategy I played around with Friday night and all weekend, guys. I was on my computer just kind of playing around with this strategy. And anyway, yeah. So that's kind of my new play toy, if you will. But I don't want to dig too deep into it on my streams till I really master it, which I think I already have. But we'll talk about it more, more in the future. So for the time being, I'm just going to go ahead. Let's see here. So anyway, yeah, let's just go ahead and take a look. So we've beat Aussie dollar to death. Gold and silver, guys. Let's get rid of my moving averages now. Good. Take a look over here. Daily chart. Okay, we had the gigantic Friday close down for the gold and silver, really all the metals. Sunday into Monday. This was a continuation down. We did chew through this daily demand zone that I was keeping an eye on for gold. But then we got another big, wick underneath wick. So a couple rejection wicks really on the last 3 days of candles. I mean, this indecision candle we had clear at the top from Thursday. Okay, that was a big indecision candle, was it not? Because you had wicks on both sides. It just so happens that the shorts won out, the profit taking, the geopolitics, all of the influencers, caused this to push down. And then a continuation on Sunday, Monday. Okay. I say Sunday, Monday because again, the market opens in the Americas here. It opens Sunday evening. And then of course, continuation through Monday. So, but ever since the intraday session closed Monday here in the States, the crossover, we've been up again. So did we catch a bid? Okay, that wick, if you look at that wick, it does drop down into another daily demand zone. You got 1, 2, 3 basing candles right down here. Oh, by the way, it just so happens to have a former resistance point going through it from this price action over here. Now, I had no interest in buying, even though I figured it was probably going to catch a bid on one of these two demand zones, whether it's the one it chewed through or obviously this one here. Okay, and as you can see, it just so happened. Just so happened to be the demand zone on the bottom. I mean, look at that. That's daily. Look, did it touch it? Yeah, look at that. Pretty damn close. Okay, it missed it by what? A penny or two? Okay. But the point is it got down to that demand zone before it bounced. So that's what we're looking at now. That's a daily. Now, what are we looking at? Now, number one, guys, I don't have a signal to buy. Okay, these are pretty well neutral. Gold and silver are still. There's gold right there at a neutral -1. If anything, it's trying to say sell. But we're not going to sell anything in the 4 to -4 range or buy. Okay, we're just going to let it go. Where's gold at? Silver's down here, -4. And then gold, -1. So not interested. Not interested in buying or selling. But if I'm only looking at this from a technical perspective, then I have to zoom out. When in doubt, zoom out and observe that this thing's just strong despite that big, ugly sell-off, despite the geopolitical tensions easing up. Okay, despite all that, this is still a very strong uptrend, is it not? There's your weekly, there's your monthly. Okay, even on your daily. Because if I'm looking at swing lows, if I'm looking at impulse legs, I have to look at this down here as a swing low, obviously. Oops. Okay, this is obviously a swing low, big strong drop, and then a reversal upwards. We also had a swing low right here. Big strong drop. Okay, remember the earth was caving in back at the end of the year. Remember that? The world was falling to pieces, guys. Gold and silver dropping like crazy, only to turn around and see this move here. This brand new impulse leg up. So on a daily time frame, guys, this is still the current impulse leg we're in. We are always in an impulse leg. Now, yes, when it comes to currency trading, currency pairs do have a tendency of longer term going straight sideways. Okay, they just don't trend as much as stocks and indices and gold and silver, Bitcoin, that kind of thing. But every single price action of every single asset is still within an impulse leg. Okay. So there's your impulse leg on a daily. we're clearly in the middle of this impulse leg, are we not? So if you want to think about trading on a very fundamental, a very simple technical level, okay, always observe where your current impulse leg is. Now, this is different depending on the hour, depending on the time frame that you guys like trading. If you're a daily trader, okay, this is your swing low, this is your swing high. If you are a 4-hour trader, you're in an impulse leg from this swing high to this swing low. Okay, you're in the middle of that impulse leg. Watch this. If you're an hourly trader, this is your swing low, and you're at the moment you're at a swing high. Okay, so this would be the impulse leg because it's breaking some of these structures. The definition of an impulse leg is has that leg broken structures? Okay, that 4-hour impulse leg down. Okay, broke structures here, broke these swing lows here, these swing lows, these swing lows. So the idea is, if you're in an impulse leg, when does that new impulse leg start? In other words, when do you break this swing high? Or when do you break this swing low? Because when you do that from that particular time frame, well, that's where you want to look for a supply or demand zone as a continuation move. So in other words, let's just say this current 4-hour leg. When this 4-hour leg, let's just say it breaks this swing low, okay? In other words, it breaks this impulse leg. It has a break of structure down. Well, when let's just say this comes down. If this comes down and breaks this structure and closes and starts a new, smaller time frame counter trend, well, that just simply means now you want to find a supply zone in this brand new formed up leg to latch onto. And the reason it's strong is because it had the strength to break a structure, break a swing low. So ideally, we'd be wanting to find a supply zone, somewhere up in this area to latch onto the downside, just like that. Okay? That's kind of a simpler way to look at technical analysis, I think. Helped me out a ton. Hey, if I'm in an impulse leg, great. If I've broken through a structure, though, now that I know that I'm in this newly formed impulse leg down, well, that's telling me there's some strong supply up here. There is a strong enough supply zone somewhere in this area to push price down and break new lows, because that now turns this into the impulse leg that we're in. So all you got to do is look for your supply zone. Now, the same is true in reverse if we're looking at a demand zone. Okay. Remember, anytime I talk supply and demand, if I'm specifically talking about one or the other, the strategies, they apply to both, whether you're looking at long side or the short side. Good morning. Hello, Ilhouse. Good to see you again, my guy. Hey, what are you trading anything today? Let me know. Let me know if you're looking at any specific assets, currency pairs, gold, silver, Bitcoin, indices. I'm turning off my fan because it's getting hot. I didn't realize it was going to turn back on when my circuit breaker reset. So yeah, guys, let me know what you're looking at as you pop into the chat, if you would. Let me know, as always, where you're from, just in case I didn't catch it the last time. I like to know where everybody's at, because I love geography. I love maps. You guys, I'll spend hours sometimes just looking at maps, Google Maps, Google Earth. I just like to see all these other countries and places I'd like to go to at some point. So it's always fun to know where you guys are. So yeah, let me know. Let me know where you guys are chiming in from. Hello, Billy, Aminu Sadaki, and Zambez and Zambizi Mac. Howdy. Thank you, guys. Thank you. Appreciate you chiming in, saying hello. Yeah, just a quick recap of what I've went through today. Okay, just monitoring my Aussie dollar long position. Again, it's looking pretty decent right now, $970 unrealized profits. We've broken this structure, which made me feel pretty good about this trade on this candle right here when that candle closed. At this point, it retraces, and I'm fine with that. Okay, retraced into this new impulse leg. Okay, new impulse leg right here. So that just tells me there is a demand zone somewhere in there. There you go. That candle right there. That candle produced a gap just ahead of it, which made that a pretty decent spot where demand exceeded supply. So if demand exceeds supply, if and when price rolls back around to it again, there's a nice chance that it could turn around and catch another bid and form another impulse leg. Zambezi River, I've heard of it. I have heard of it, but you might have to remind me where that's at. Zambezi. It's not in Africa, is it? Zambezi. Sounds like Zanzibar for some reason in my head. I don't know. I may be way off, but Zambia. I should have known that. I was thinking Zanzibar or Zambia. Of course, Zanzibar is where the great Freddie Mercury is from Queen, my favorite band of all time, guys. I'm sure everybody, that's one of those people like Michael Jackson or Elvis. Everybody knows worldwide. Queen. Of course, my favorite song of all time from Queen is Under Pressure, that he wrote with David Bowie, who's they're probably tied for top one. I don't know who's number one and number two, guys. I always go back and forth between Queen and David Bowie as far as my all-time favorite artists. But yeah, that just so happened to remind me of Zanzibar, which is Tanzania, which is where Freddie Mercury was born. Now that we're past our music lesson for the day, let's take a look at what else we got, guys. So top setup. So I'm still keeping an eye on, excuse me, clear my throat up here. Just moving a couple items real quick. Okay, New Zealand yen plus 11. New Zealand Swiss and Aussie yen plus 10. Aussie Swiss plus 9. So those are my top 4 very bullish assets. So that is obviously the first place I would like to go to when trying to find something to buy. Can I have a look at the FTSE? Absolutely, Zambezi. Yeah, let's take a look at that. When it comes to the FTSE, okay, number one, it is giving me a neutral signal. It's over here somewhere. FTSE. Did that change? Where are you at, Nikkei? Or Nikkei. FTSE. Oh, right there. Okay. So UK 100 minus 1. So that's just too neutral of a score for me personally to want to go out and buy. Technicals are straight up neutral. The big banks and institutions combined with the retail traders, if anything, is giving me a sell signal. And then the fundamental analysis, okay, all the fundamental reports, the high impact events from the pound, if anything, are barely saying to go out and buy. So it's just too contradictory of a combination of signals. So that's your fundamental and sentiment picture. But if we're looking at the technicals, let's go take a look. Day chart. Let me reset this. Okay. Obviously, guys, just like with all these other indices, it's going nice and straight up. I do have a VWAP line down here. Now, it looks like we did bounce into this daily demand zone I had the last time. And as you guys can see, the last time I would have looked at the FTSE would have been when price was up in this area, because my boxes, I always put my demand and supply zone boxes out just a little bit ahead of price. But as you can see, now we're behind price. So it's been literally that long since I've looked at the FTSE. Okay. So, but because it was in neutral. But as you can see from a technical level, demand zones still work, even though the fundamentals aren't always agreeing with it. We came down, bounced into this daily demand zone right here, wicked in nicely. And as you can see, we bounced up. So very nice trade for anybody that might have got into this daily demand zone. But now it's used up, right? It's been touched. It's been mitigated. So if it's been touched and mitigated and used, I don't want to reuse it, because chances are when price returns, well, those unfilled orders that created that demand zone probably going to be used up, meaning the price could just chew right through it and go down to the next demand zone. Now, you see there is a green box inside. Well, that's because I got a 4-hour demand zone. This is my confluence. This is the confluence I like to look at. That 4-hour demand candle right there, which had a gap from here to here. Okay. So that shows that demand heavily exceeded supply. concentrated at the bottom of this daily demand zone. Now, I would have wanted to get in the trade if price would have come down and obviously touched the 4 hour, okay? Because the 4 hour is the confluence point, and then go for a potential buy up. But as you can see, we missed it. It caught a bid at the upper end of, well, pretty much the middle, I guess, of the daily zone itself. So does that mean that this is still in play? Yeah, absolutely. Okay. There's still a demand zone that has not been touched. Let me go study this just a little bit more real quick, just to make sure it's not, yeah. So see here, let me move the daily box out of the way. So we're looking at this candle right here. Okay, so I need to see where my gap is, and it's from the top of that candle to the bottom of the second candle over. So as you can see, there is a fair value gap, but it's just not the strongest. If it were strong, this gap would be, up, somewhere up in this area, meaning it would be higher up. It would be bigger. It would be much more of a demand supply imbalance, but it's not. It's just that little gap. So yes, it is a demand zone, but if price were to return, I wouldn't be putting on a full position. Might just take a stab at it. I mean, at the end of the day, when it comes to supply and demand zones, I like to see at least two, which I did have two green candles, if not a third. Well, the third one kind of rolled back over and got lazy and went sideways for a few bars. So it's a demand zone, and it is inside of a daily confluence. It's just not the strongest. And plus, you have a demand zone underneath. This is a zone on top of a zone. So that's a pretty good confluence as well. Now, what I would probably end up doing if I were, for sure wanting to get into this trade down here, I would probably buy a partial position if price comes into this demand zone here, with the anticipation that price may drop right through it, in which case I would buy another partial position. So another half from this demand zone, and then I would be putting a stop loss underneath here, underneath both demand zones. So I buy a partial position here and immediately put my stop loss underneath the demand zone underneath. Now, if it bounces into this demand zone and just turns around and runs away upwards, okay, well, I've missed the other half of my position, but I'm still making some kind of money from it. Okay, this is what they call dollar cost averaging, but this is a dollar cost averaging with an actual purpose and an actual plan. Okay. I emphasize that because a lot of people dollar cost average without a plan. If you're going to dollar cost average, you got to have a plan. Meaning, don't get in a full position 2 or 3 times. This is only putting on a half a position with the anticipation of price. If I'm wrong, okay, forget this demand zone for a second. Okay. I have to incorporate that demand zone if I'm going to dollar cost average in. So in other words, I buy a chunk here and then I turn around if price drops and I buy another chunk when we get down here. You see that white dashed line? That means I've got a 1 hour demand zone inside of here as well. That's my confluence. So let's take a look at this for the FTSE. Let's go. Well, let's just stay zoomed into where we were at, actually. Yeah, let's just stay here. So, when it comes to how do I operate this? Well, let's just pretend price is right here. Okay. If price comes in, I'm going to buy a half a position right here because we have bounced into the demand zone. And if price goes up and runs off, okay, well then congratulations. This demand zone was the strongest. It won out. I still make money. I just don't make a full position worth of money. But let's say price turns around and rolls over. Okay, now we've come down to the bottom demand zone, and this is where you fulfill the other half of your position. So it's one position. It's broken up into 2 parts. Now, you got to be careful because some challenge accounts frown upon this. But if you have a cash account and you insist on dollar cost averaging, this is a way to do it. And then obviously your goal is for price to go up and profit on both positions, which is technically 1 because it's split into halves. But obviously if it goes against you, now you've just lost the equivalence of one position. If that makes sense. So anyway, I kind of got off on a sidetrack there. If I'm looking at what I can do with it, real time, well, there's a demand zone right there. There's a nice looking 4-hour demand zone. Let's look at this for a second, guys. There's your 4-hour FTSE demand zone. Okay. Remember, a demand zone for me has to always come from a newly formed impulse leg. Where's my newly formed impulse leg? Well, it's going to be obviously this swing low to this swing high. Why this swing high? Because it broke this structure. When price breaks a structure like that, okay, when price breaks that structure, the minute it breaks that structure and closes, this is our brand new impulse leg. Where do I like to buy pullbacks? From the current impulse leg. So anywhere in here. And obviously, you guys, if you've people that have been watching me as long as, some know that I like to buy my demand zones or sell my supply zones as close to the origin of that strong move as possible. So obviously the origin is the swing low. So the idea here is take your fib based extension. You don't have to do it. I'm just doing this just for visual, but I want to go from the swing low to the swing high and then just connect the dots back to the swing low. So the idea here is this breaks the swing low to swing high into thirds. Okay. The top is your premium zone. The bottom is your discount zone. And then the middle is where you tend to get chopped to pieces. The retail chop zone, the diddle in the middle. I want to ideally buy when price drops to the discount zone, which is the bottom third. Well, what do you know? Our demand zone is in the bottom third. So that makes for a pretty good spot to be watching on this demand zone. Now that's 4-hour chart. I always take whatever price I'm looking at and divide it by 4 and then go look at that time frame to make sure that I'm getting some type of confluence. In other words, am I getting I know I've got a 4-hour demand zone. Now that I've moved it to a 1-hour, which is 4 divided by 4 is 1, right? Simple math. Do I have a 1-hour gap? Do I have a 1-hour demand zone? Well, I do, because here is my gap right here. Look at that. That is a 1-hour gap based off of this 1-hour demand zone. So I have a strong 4-hour gap. I have a strong 1-hour gap. This is a pretty nice spot from a technical perspective to buy this asset. So I'm going to personally just go ahead and put an alert on there, even though I'm not interested until I'm not interested unless we get a bullish signal on this thing. But I will still keep an eye on the alert, and I'll refer back to you if this hits in the next day or two. How's that sound? So I'm going to put it up here at the 4-hour proximal line, though. But if I were trying to buy this now, remember, I'm looking at the 1-hour demand zone. So the 1-hour is actually where I'd be wanting to buy. I don't want to be buying from the 4-hour. I want to wait till I get another set of eyes on this asset from the 1-hour zone traders, because now they're looking, now both are looking at the same spot. Okay. And then from here, we look for some type of a manipulation, and then we buy the market like this. So, let me just move this out of the way. Okay. So price has dropped into the 1-hour zone. This is the way this is how you confirm your trade. Okay. So short-term counter trend move. Okay. We got swing low, swing high, lower low. But now, instead of having a lower high, we have a higher high. See this high here? It broke this high here. It broke this structure. The process, this is how you confirm your trades. This is how you confirm them to feel a little bit more comfortable about your entries. Because if you do not get a higher high and this turns into a lower high like this, okay, well, you just avoid the trade because now it's pushed down through your stop loss. But you weren't in the stop loss or the order to begin with because you did not wait for it to confirm. If you wait for confirmations like this, guys, it'll save you from so many losses. Just zoom in a little bit. Okay. Because if you keep seeing lower lows and lower highs, it just keeps you safe. It keeps you out of this trade. But the minute you see price at least attempting, I'm not saying it's going to, but if you see price attempting to break structures to the upside, well, there's your trigger to get into the trade on a pullback. Because typically what happens, remember, I just talked about this on the impulse legs. This is a new impulse leg, albeit on a smaller time frame. Impulse legs tend to leave some pretty decent supply or demand zones in its wake. So in this case, it would be, somewhere in this area. And then you would wait for the pullback. And right here is your order. Right here is where you buy into the market. This is your trigger point. That is your trigger to buy this asset right there. So price has a temporary small time frame counter trend move, but then we finally break our first structure to the upside after we've hit a 4-hour and a 1-hour demand zone confluence. That's the key, guys. You can blindly just buy into these zones whenever price touches it, but it's not really confirming itself. As you get much, much better at, after you put in 10,000, 20,000 hours looking at charts, then you'll get to a point where you know which zones are probably going to hit, and you can just put in a limit order. But for a beginner, for a new trader, and when I say new, guys, I'm saying under 5 years. And I know that sounds ridiculous, but it takes the basics of trading are simple. It just takes a long time to master these types of nuances. But I would say, regardless of what trading strategy you're looking at, if you utilize this basic model of confirmations, it'll keep you out of a lot of losing trades. So price comes, and even if you're a support resistance trader, right? Now, I don't trade support resistance because I personally like to look for the unfilled orders from zones, demand zones and supply zones. But this same thing works on a support resistance bounces. Price comes down to your support or resistance line. And the minute you see this break a structure to the opposite side, now most people call this a change of character. I just call it a break of structure. Keep the words easier. Who cares? Change of character, blah. It's a break of structure. It's breaking this upward. It's breaking this swing high, this lower low, or this lower high, rather. Sorry, guys. This will keep you out of a lot of losses right here, regardless of your trading strategy. Okay, so anyway, that's where I'm going to have my alert for you, is going to be right here at 10,177. That is what I was looking at. I was also looking at a lower daily. I prefer to have monthly, weekly, daily, and lower time frame all covering each other. But that is not always possible. Man, that's beautiful. That's exactly what I try to do. I try to go through as many time frames as possible, and I'll get pretty crazy at it because my trading always starts from a daily time frame. Where's my daily demand zone? Okay, great. I have a daily demand zone. Now, do I have a 4-hour demand zone inside of it? Okay, great. Now I've got a 4-hour. Do I have a 1-hour? And I just keep dividing by 4. Now, daily to 4-hour obviously isn't, divisible by 4. I mean, it is 6, 12, 18, 24, but I just like the 4-hour chart because that's what I feel like that's probably the lower end of what the big banks look at. Is a 4-hour. So from the 4-hour, that's where I divide everything by 4. 4-hour down to 1 hour, 1 hour down to 15-minute, right? But I'll go through all those time frames and just see, hey, do I have a gap? So like we already know we got a 4-hour, 1 hour here. What's our 15 show us? Right? And I'm just going to actually delete. Let me do this, guys. I like to just use one set of rectangles. When I start looking for my smaller time frame zones, I'll just put a line like that. And that just tells me it's the proximal line of that zone. So now do I go down to a 15 and find a gap? Right? Obviously, I go down here. I see I've got a gap here as well. Okay, but only this time the gap is all the way at the bottom. Now, okay, this is a great lesson. Actually, now that I see this, so you guys, my goal is always to look for the supplier or demand zone that is as close to the origin of the overall strong move up or down as possible. So in this case, this is clearly the demand zone. Let's get this out of the way for a second. And let's get rid of our gap since we already know we got gaps here. Okay, remember this white line is my 4-hour demand is up here. But my 1 hour demand is here. Well, now I'm down to a 15. So if I'm down to a 15, I see I've got a gap here, right? Is there not a very tiny gap from the top here to the bottom of that second candle? It is very small, guys. It is, I see a space. So you would think, well, I would want to be plotting my rectangle on this demand zone candle down here, right? Well, but there's also one here, right? So which demand zone do you think would probably have the best shot? This one that's higher up, or this one that's at the true origin of this overall strong move up? What do you think? Which one of those do you think you would want to take? Which one would catch the bid the best? The potential. Now, there's not a guarantee. Okay, nothing in trading is guaranteed. This is just nothing more than stacking probabilities in our favor. But which one of those demand zones would you rather take? Take a drink of water, guys. Finished my energy, so I'm going to start turning some cartwheels. Okay. When it comes to these demand zones, I do not want to be taking this one. I want to be taking a trade off of this one. Well, why, Tiger? You have a gap underneath it. Are you crazy? Well, extreme. Okay. Honestly, I like both because, again, this is the strong, the origin of the move. But what I like better about this demand zone and why I would not wait for this candle, I would just take a trade here. The reason I like this is because twofold. Well, number one, the gap is much stronger. It's got a much stronger acceleration gap outwards, right? That's number one, because there's your gap on that second one, and down here your gap is that big. That's tiny. That's kind of like weak sauce. So if we're just looking at gaps, then to me, this top one wins. Now, what's the most important reason? Well, it's the volume. It's the volume spread analysis. It's the trading activity that happened in these candles. This candle here, if we look at the volume spread analysis candle, okay, just barely a little bit higher than the candles, before it that preceded it. Not that much of a difference. This one, though, on this leg out, on this big green candle, look at that big red candle. That's a lot of push. That's a lot of push. So in other words, do I want to wait for the extreme demand, or do I want to just buy the zone ahead of it and then take my stop loss and keep it underneath the bottom one? Well, that's what I would choose to do personally, because when I see volume like this, chances are price is going to potentially drop in, catch a bid there, and run off, and may not even make it down to my candle, or the origin, the extreme candle, as you put it. So I would be getting into this trade from this candle, which, by the way, coincides with our 1 hour demand zone. Okay, remember this white line up here is our 1 hour demand zone, and then obviously this is the 4 hour. So it's kind of there's no really right or wrong answer, but I just say I would want to be, rather than wait, I would want to put it here because chances are price could come in and then I just miss out on the trade completely. So, this just comes down to a person's risk tolerance, okay, as to which one of these zones you take. I would normally be with you there by the extreme, but when we have this big of a difference between the volume candles, the volume spread analysis candles, the VSA. Okay. As always, guys, you can find this on a trading view. All you got to do is just type in right here, volume spread for VSA by Hari Prasad is the name of the developer. Volume spread for VSA. This is pretty much your tick volume. Obviously, currencies don't have centralized volume like stocks and gold, silver, everything else. But it does show how much trading activity happened within a given candle, and who has the power to just throw up ultra high volume. It's the banks, it's the institutions, it's the hedge funds. If I see that they're getting involved somewhere, if If I see that they're getting involved somewhere, I want to be following them. I want to be riding their coattails, hitching my wagon on them. Okay. So again, just an odds enhancer. It's not the end all be all. None of this stuff is. All I want to do is try to add as many odds enhancers in my favor as possible. So yeah, that's where I would get into this trade, which would basically coincide once again with, the higher time frame demand zone. So that's your your footsie. I kind of beat that to death, didn't I? All right, guys, let's take a look at a couple of these other top setups. Let's look at New Zealand yen. Let's look at New Zealand Swiss. Okay, I've got alerts on all these. New Zealand yen is down here. This is our strongest asset at the moment. Got several demand zones underneath, but I really only care at the moment about the closest one because we do have, it's pretty much your 50% retracement if you're a fib trader from this swing low to swing high. I don't personally use fibs a ton, but I do like to use it just as a filter if I'm undecided. Maybe I've got all of my trading rules working, but sometimes there's just that gut feeling like, I don't know. You've been around this stuff long enough, guys. I've probably put in 30,000 hours on this chart time in my 12 years. So there just comes a point in time where your gut kind of tells you all you need to know. When you start looking at structures and shapes and patterns and everything. Yeah, you're welcome, Zambezi. That was a good little breakdown. So, but anyway, sometimes the fibs can kind of help because, but I use it to see where the retail crowd is trading. Remember, I want to trade like a bank. So if I'm trading like a bank, then I want to know where the retail crowd is. I want to know where they're entering trades. I want to know where they're putting in stop losses. Stop losses equal liquidity at very prevalent spots where retail traders put their stop losses. So if I know there's a patch of stop losses somewhere, then I could play around with the price action, manipulate it to go to build a position to go ultimately into a trend in the direction I want to go to. So anyway, that's that sounds cutthroat, but that's what trading is, ladies and gents. But anyway, New Zealand yen. Let's see here. I'm going to go to a 4 hour. And let's see. Yeah, there's a lot of wicks. This is kind of an ugly chart. I mean, it's trending upwards. We did break this structure up here and closed, which is nice. So, if I'm looking at this leg here, okay, this is, like I said earlier, this is my new impulse leg because we got a higher low, and now we officially have a higher high. So I can look at this at quite a few different time frames. If I go back to my daily, well, I got a daily demand zone all the way down here, which is actually, yeah. Oh, I don't have an alert. Do I not have an alert on here? Oh, I do not. Okay. I'll be putting an alert on here. Well, anyway, this is my most recent daily demand zone, which was an impulse leg because it broke a structure. So we got swing low to swing high. As you see, price pulled back and caught a bid somewhere in here. So now we have a new impulse leg starting here to here because now we broke this structure. So this is your new swing low. This is your swing high that broke this structure. So our impulse leg now is through here. So we go down to a smaller time frame, 4 hours. Do I have a decent looking demand zone in here? Absolutely not. Because if you look, all these candles, let's get rid of the drawings for a second. All these candles are overlapping the wicks and bodies all the way up through here. See down here, this would be a nice looking 4 hour demand zone. But the problem is that wick right there came back and touched it. Did it not? So that's off limits. Well, what about that? Look how strong of a gap that left in its wake. That's got to be a good demand zone, right? It's got a good, strong fair value gap coming out of it. Well, it was until price come back down, closed the gap, touched the demand zone, collected the unfilled orders, and then pushed price up. That was a very strong demand zone at one point, but now it's touched, it's mitigated, it's useless to me. Okay, let's keep going. Let's find our demand zone. Okay, these are all overlapping candles. In other words, overlapping candles means efficient market. Efficient market structure all throughout here. There are no gaps. no gaps until we get right here. That's your first gap right there. Is that your first gap? Now that's this time frame. That's the 4-hour time frame we're looking at. There are no gaps until we get all the way up here. And that's coming from this candle right here. So let's just drop some time frames, because as we drop time frames, okay, then we'll be able to find some gaps. Obviously, we'll be able to find some zones. Remember, that's my gap. So do I have a demand zone here? No, I do not. Well, I do. It's just a little fatter than I like. Okay. In other words, the candle is going to be up here like this. And the expanded range candle that left was good to start, but then it fizzled and got boring. We had 2 straight indecision candles, right? So that's part of the reason I don't really want to use this as my demand zone that's actionable. Well, let's keep going down some smaller time frames. There's your 30-minute. Okay, 30-minute changes to that. Didn't really have but just the one expanded range candle. This is starting to look a little better. And the reason I use this is because on a now 15-minute time frame, I had the expanded range candle leaving the zone, so demand heavily exceeded supply because we had a nice fat gap from here to here. That's a pretty strong gap right there, guys. But we had 1 green candle, 2 green candles, 3 green candles. That's the reason, because when I have price leave a supplier, when I have price leave a consolidation area that inevitably becomes a supplier demand zone, as price leaves, I like to see at least 3 candles, three nice sized candles exiting that consolidation. When I see 1, 2, 3 exiting candles like I do in this example, when I see that, then I want to wrap a rectangle around the base of that as soon as I possibly can. Okay. So 1 candle is basically your consolidation is 1 candle, 2 candles, 3 candles, 4 candles. And then I would just say that this is kind of your leg in. Okay, these candles here, your leg in, and then we go sideways for 4 candles. So that would basically be the, let's do this. This is your consolidation right here. Okay. That's your consolidation. 1 candle, 2 candle, 3 candle, 4 candle. I'm just ignoring the wick, basically looking at the full candle, which I honestly wish this candle was down even with this wick down here, but it's not. But yeah, you guys can clearly see we got some basing, right? 1, 2, 3, 4 candles. So that turns into my 15-minute demand zone. 15-minute demand zone with unfilled orders. It was only 4 candles. Okay, that meets my requirements. If we had 6, 7 candles in this basing action, I wouldn't be interested, because that's too much time at that price point within that time frame for any potential banks or hedge fund activity to get their full order in. Remember, the whole point in a demand or a supply zone is banks don't have enough time, finding the ones where banks clearly didn't have enough time to put in their full position. Remember, they're putting in $1 million positions, $100,000 positions, millions, okay, billions, right? They need time to accumulate or distribute that position if they're in the, trying to go for a downtrend, right? That'd be distribution. Accumulation, they got to have time to do it if they're trying for a big, giant trend, upwards trend. So if I see a whole bunch of candles, like right here as an example, or even right here where we're at currently, that's too much time. But if I have price leg in to a price point like this and then go sideways and then quickly leg out, that's not much time spent right here for a potential full accumulation of a smart money position. So those are very attractive points where if and when price returns, I could see bounces like that. I'd be buying in demand. I would be, because they're putting in the rest of their order if price comes down. Remember, they're buying low and selling high just like all of us. So when price comes down into a demand zone, they want to put in the rest of their order. And oftentimes it's just one more fell swoop and then price goes up. If it's a good demand zone or supply zone, price will hit the zone and fly up immediately. If price hits a demand zone or a supply zone and just kind of goes sideways for a while, well, that's not what I want to see. May not be that strong of a zone. Maybe there wasn't as much leftover ordering that we thought, right? So ideally, the price comes down to the zone and just screams back up like that. If it comes down here and goes sideways, sometimes may just get the hell out of the position. Go find a stronger supply or demand zone, right? So anyway, New Zealand yen, okay, again, that is currently our strongest score. So that is currently where I would be watching from a pure demand and supply method. We got we got some pretty big volume spread analysis candles at the bottom as well. Look at that leg out. Leg out, we got a nice red candle. That's ultra high volume. And again, I attribute ultra high volume to the big boys, the smart money, the whales, okay, the big banks, the hedge funds, the insurance groups, all those types of people. Right? So that's my spot right there. And you got a 200 moving average down here as well. Okay. So it's a pretty nice spot. 200 average, 200 exponential moving average. So I do like that. For probably my number one, trade. Now, Aussie yen is right there as well. It's a plus 10. But I personally would rather trade the New Zealand yen instead of the Aussie yen. Why is that? Well, because I'm already in an Aussie position. Right? I'm already in the Aussie dollar position over here. Aussie dollar position. So if I'm already in the Aussie dollar position, then I don't want to personally double up my risk on any one currency. In this case, the Australia dollar, right? So I'll trade the New Zealand yen, and it'll kind of help balance out the risk a little bit among the Australia, New Zealand currencies. The neighbors, the cousins, okay, the twins, whatever you want to call them. Well, I wouldn't call them twins because Australia is much bigger, but the neighbors, we'll call them neighbors, right? So anyway, that's New Zealand yen. But yeah, Aussie yen, again, it's still looking pretty good as well. We got a pretty good zone, kind of in a roundabout way, the same spot as the New Zealand yen. So yeah, I mean, this is equally a good spot. I've got an alert set on both of these. Volume spread analysis candle spike on that leg out candle, showing that demand heavily exceeded supply with a small amount of time there, meaning there's potential unfilled orders that the banks want to finish off. Price comes down, fell swoop, price flies up. That's the goal. That's the idea with Aussie yen and with Kiwi yen. So we've covered that. Let's go ahead and look at the New Zealand Swiss. Now, remember, the Swiss franc is the weakest currency right now. Weakest currency. Let's go to our Eco Surprise Index. Okay, Swiss franc. Hold on a second. Let me refresh this. It didn't quite load properly. Come on. Well, while this is loading, guys, I do want to let you know I will be on Trader Nick's podcast here in a bit, or his live stream. If you go to a1trading.com, this is his site. You can go to over here to where it says A1 live stream. And this is the schedule that he has. He always puts this up about a week in advance. So there you go. There's me at 9:30 a.m. Eastern Standard Time. So 8:30 my time. I'll be on his podcast. You can always just click over here. There's the YouTube link. And then I'll also be on his live stream on Friday. Okay, Friday as well. Right at when I finish. Right when I finish my live stream. So I may actually on Friday, guys, have to quit just a few minutes early. Just like 5 minutes early, just so that I can get prepped and get the link, the StreamYard link to that one on Friday. That way it's just an even crossover. So that's coming up. As always, you could just simply go to YouTube, and then you can go over here right here. Okay, Trader Nick. So this is where you'll be able to find it at Trader Nick. Real simple on YouTube. And then just click over on his live stream section, and there you'll find his live stream. So I'll be on there here in 45 minutes. But yeah, I just wanted to show you that while this was loading over here. And it's still not loaded. What the hell is going on here? Let me refresh it one last time, see if it works. Come on now. Okay, there we go. We got all our goodies now. So this is our updated, up-to-date economic surprise index, the currency meter, and we have a new, wait, do we have a new leader? Let me, oh, I can't, oh, sweet, I didn't know I could do that. We have a new leader. So you guys remember the Australia dollar was the #1 currency over here for the last week and a half, 2 weeks, something like that. New Zealand dollars passed it up. So it is now the strongest currency from a fundamental analysis perspective. Okay, fundamentals, meaning the economic releases, our economic calendar, right? Our Forex factory or whatever economic calendar you use. So Kiwi, #1 at 83%. So it's exceeding expectations on 83% of its high impact events. Let's go look at it. Let's go look at the currency, the New Zealand dollar, the New Zealand buck, the New Zealand Kiwi. And as you can see, now why did it change? Oh, okay. It's just not colored. Okay. So this should be, oh, no, that's not right either. Oh, that's right. They were tied. I totally forgot, guys. The Aussie. So it's the nothing changed on the New Zealand dollar because it hasn't even had a release, an economic release since the 22nd. Okay, that was back when their CPI report came in a little bit warm, pushed them to bullish, pushed them into the second spot with Australia. But Australia, okay, they have now had a why did this not update? It updated, but I just must not have seen this yesterday. So yeah, Australia, their most recent report was, a couple days ago, they had their manufacturing PMI data come out where they did have just a little bit of a cooling. Yeah, so this is all making sense now. So they expected, or they forecasted their manufacturing purchasing managers index number. They forecasted it to remain the same 52.4. But they did drop 0.1. So that changed this to a new bearish category instead of bullish. So that's why Australia has now fallen from the top spot. But it is still strong, and I'm still holding on to my Aussie long position, Aussie dollar, US dollar long position. But, again, I like to see my currency that I'm trying to buy remain the strongest. It still is, if we go back to our index again. Please load. Okay. So I'm long Aussie, which is 67%, and I'm short the dollar, which is 64%. So it's pretty much the same strength, guys. I like it when my buying currency is much higher than the weak currency. So if you're just trying to get into a trade over here, a very simple way to look at it is take a look at your recent collection of economic report releases. Okay, from your economic calendar, whether it's Forex Factory or whatever calendar you use, and find out which ones are exceeding expectations. So basically, in this case, the weakest currency I have is the Swiss franc. It's only exceeded expectations on 1 out of 3 of its reports. Okay, 33%. So I'd be wanting to match up one of these strong currencies with us. So New Zealand Swiss, okay, Euro Swiss, Aussie Swiss. Now, pretty much the other currencies are pretty strong. The Japanese yen has gotten a little weaker, though. So the Japanese yen, as far as I'm concerned, is right there with the Swissy as far as currencies to short. So it's, just very simply match it with one of these stronger currencies, and you've got yourself a potential trade plan. Let's go look at the Japanese yen. What changed on it? Okay. February 1st, they had a neutral PMI reading. 29th of January, they had a negative retail sales, which was not good at all, to be honest, because they were previously at 1 and they expected to drop 0.3, but they dropped a hell of a lot more. They dropped 1.9. Wow. Japan's retail sales, not good at all, guys. Not good at all. And then they had a neutral reading on their unemployment rate. So 2 neutrals and 1 bearish. So they're now, guys, only exceeding expectations on 40%. which is the household spending, and the services PMI. Okay. So it's no surprise, having said all that, since I know that New Zealand is the strongest currency, it's no surprise to see two of the New Zealand pairs at the very top of the list. New Zealand paired with the yen, which remember is the second weakest. New Zealand Swiss is our number 2 asset. Strongest currency versus the weakest currency. And then Aussie yen and Aussie Swiss. So yeah, it's no surprise. As you start to understand when currencies are weak and strong, it's no surprise to see those currencies matched up on here. So let's just do that. I've got about 9 minutes left, it looks like. Let me just double check one thing over here. So as far as today goes, guys, at 3:45 my time here in Kansas City, 3:45 p.m. Central Standard Time, 4:45 p.m. New York City time, we do have New Zealand's unemployment rate and employment change numbers coming out, which is kind of an odd time of day. I don't really normally see those reports at that time of day a lot. I don't know. That just seems like a weird time frame for them to release it. Right before the okay, I see what they're doing. So they're just basically closing it right before the currency market rollover. 15 minutes. Because the market rolls over at 4 o'clock my time, guys. So that's why they just want to wait till everybody's got their orders good and in, and then rug pull you. So that's our only red folder event, our only high impact event today. Do have a couple speakers this morning, FOMC member Barkin and Bowman for the buck. Okay. More light impact events, but sometimes their lip flapping sessions can bring out some big news. So I like to try to look at readouts of these. You can do that by just simply going over to the calendar, Federal Reserve Bank, click on latest release, and then quite often those speeches will appear right there. Right here, speeches. Then you can go get the words. You can run it through your Grok filter and say, hey, does this sound dovish? Does it sound hawkish? Is there anything potentially market moving coming out of this? Yes or no? And it'll save you a whole bunch of time reading. But always cross-reference it. Always double-check. Make sure it makes sense. Make sure it's not saying it's dovish when it's actually hawkish or vice versa. You got to double-check that. But this at least saves you time by filtering things. Because it understands how to sift and sort and at least find those lingos. But I have seen, guys, where I had this happening the other day where I filtered one of the speeches and it tried to tell me that it was a dovish reaction when in fact I knew that it was hawkish. And so I had to tell Grok to basically look at what you said and reevaluate what you just told me because that's not right. That was the first time I saw that. And I'm like, oh, wait, yeah, I'm going to really start staying on top of you, Grok. But anyway, New Zealand Swiss, guys, I want to take a look at it before we get up out of here in a couple minutes. New Zealand Swiss, we have bounced into a higher time frame supply zone. Okay, see this candle right here? That's our supply zone, our daily supply zone. So I have to be careful about buying in this area because of that reason. I want to buy this market because it's giving me a bullish signal. It's like the second, well, it is the strongest one, but I can't really justify buying something that's in a higher time frame overhead supply zone. The forces, the prevailing forces should say that price comes into this zone, which is where we're at, and then bounces back down. So I'm just basically going to wait for a pretty decent retracement on this thing and, give itself a chance to kind of exhaust the push down, potential push down. I'm not saying it's going to, but it's a high probability. It's a risk to buy up here. I would basically want to be looking for a retracement down to the lower end of one of the impulse leg, right? Well, looking at this on a 4-hour chart, this over here was an impulse leg because it broke structure here. Then price kind of dropped, reset itself, created a little bit of a megaphone pattern, if you will. Talking about a triangle, got a trend up, trend down. Okay. And then turn around and created a brand new impulse leg because we broke this structure now. So we broke this structure. So this is my new impulse leg. So the goal is wait for a retracement as close to the origin of the overall strong move up as possible. And that's going to be here. It's just going to be on a smaller time frame. There's my 30-minute demand zone right there. Now I've drawn up a couple other demand zones up here, but I'm not really too excited about them now that we have hit this overhead daily supply zone. But I do want to at least see what happens if and when price bounces back into this zone. But I got basically like a 30-10 confluence, 30-minute, 10-minute. Or the 10-minute would be that white dash line. But that's too small of a time frame, guys. And even really this 30 minutes too small because think about it. A daily chart is going to supersede anything underneath it. It's always going to be stronger. And it's usually just going to blow right through any of these opposite zones on the smaller time frames, like a hot knife through butter. So if I'm to take a chance at buying this market, then I would at least, on the impulse leg I'm looking at, I would at least want to see price move as close to the origin up, which is down here, as possible. Especially when I do have a gap down here, 30-minute gap, right? 1 hour just doesn't look good because this wick touches this wick here. And if I used this as my 30-minute demand zone, well, that's just a large range, guys. That's too big of a range because if I take that and multiply it by 3 above this, in other words, a 3-to-1 reward risk trade, then again, we're getting into that daily zone. So I just want to drop everything. I want to decrease everything to make the reward to risk ratio work. So that's why I dropped down to the 30-minute. Because now this this reward risk ratio is much higher. It's like 6 or 7 or 8 to 1, something like that, right? Yeah. Have a good one, Zambezi. Okay. Yeah, we'll see you over there on Trader Nick's. I'll be on in 30 minutes. So, but yeah, guys, that's why I'm waiting on this 30-minute zone here. Okay. So I've got my alert there. I'm just going to see what happens. I highly, and for all I know, hell, guys, maybe one of these demand zones does work out. I'm just not going to put money on it. I'm not going to put my own money on it to find out. The first place I would put money on it is down here. Okay. It just so happens that this area also coincides with a little bit of resistance turning into support, does it not? Right. Taking a look at this little action here, this little bounce here, this bounce here, bounce here, bounce here. Is that not a kind of a dynamic support resistance type area? Looks like it to me. And it just so happens that that's where this 30-minute demand zone's at. I like it. I like it. I think that's about it, ladies and gents. I'm going to go ahead and get up out of here. I got Trader Nick's stream to do here in 30 minutes. So, and plus I need to get a link, I do believe. So I'll let you guys know tomorrow how my Aussie dollar position goes. Okay. We'll see if I'm still in it. We'll see if I go ahead and close it out today, but I'll just kind of manage this throughout the day and we'll go from there. Okay. So with that, have a wonderful day. I'll be back tomorrow, 6:30 a.m. Central Standard Time here on Trade Like a Tiger. Get ready for hump day. Talk to you later.